Welcome back, fellow investor. As always, I'm your host, Brian Davis, co-founder of Spark Rental. I am on this journey with you to reach financial independence. We get together every month as an investment club of investors. We look at different passive real estate investments. We go in on them together. We vet them together. And I invest my personal money alongside all of our members. And one of the things that we do in our co-investing club is we bring in different experts every month to give presentations, from different niches, different backgrounds and perspectives. And we get to bring a lot of these experts into our podcast as well to come and talk to you about, really quick, narrow focused topics that we can go through in 5 to 10 minutes to keep it manageable for you guys. So today we've brought in Sean Lovison. He's a certified financial planner. He's the founder of Purpose Built Financial Services. And I wanted to talk to Sean today about depreciation recapture and how that impacts your taxes as either an active real estate investor buying rental properties or a passive investor investing in real estate syndications. So, Sean, what can you tell us about how depreciation recapture works, kind of high level, and then, maybe some more, hands-on gritty strategies for how real estate investors can minimize their depreciation recapture exposure?
Absolutely, Brian. Thank you for having me. I should also mention I'm a CPA as well, so I tend to get a little bit geeky in the taxes. So,
Love it.
you know, if
Let's
I
get
go too
geeky.
far, if I get too far in the weeds, make sure you pull me back in. But I'll try to keep these numbers as simple as possible when I go through this. But depreciation recapture is a thing that a lot of real estate investors, especially in the beginning of their investment careers, don't really fully understand, and then they get really hit for it down the road, especially when they quickly decide they want to get out of an investment or roll it into something else, right? So, in just broad strokes, what depreciation recapture is the IRS has given you this tax break where you've taken depreciation for as long as you've owned the property. And when you sell it, they want that money back, right? And that depreciation has gone against your ordinary income. So what they want is they want the tax when they get it back at your ordinary income tax rates, which is often higher than what your capital gains rate is. So just to throw some numbers out there, just to kind of make it more real, let's just say that you bought a house for $100,000, you owned it for 5 years, and then you sold it for $200,000. Most people's brains immediately are like, okay, that's $100,000 worth of gains. I'm going to pay for that at my capital gains rate. Let's just say 15%. So I got $15,000 of taxes. Well, if over that 5 years, you've also depreciated that by $50,000, now your basis, so that's your cost minus the depreciation, is $50,000. You sell it for 200. People immediately think, okay, well, now I have $150,000 worth of gain. I'm going to multiply that by my capital gains rate and have my taxes. Well, sadly, the world isn't quite that simple when it comes to depreciation recapture. So what happens with depreciation recapture is you still have the original capital gains from our original example of the $15,000, which is the 100,000 times your capital gains rate will give you that one tax. And then what you have to do is you take the depreciation recapture of $50,000 and you multiply that by whatever your ordinary income rate is. So for a lot of real estate investors, they might be in that higher income bracket. So it might be 34, 37%, whatever it might be that they have to pay on that depreciation. So that can add a significant amount to your tax liability when you're calculating that out. And it can be a painful realization for people when they are just owned a property and decided on a whim almost to sell it because it was a good market, or, they needed the money for a kid's college or whatever it might be. But there are certainly ways around, doing that, realizing and getting hit by that depreciation recapture. One of the main ones is, I'm sure most of the investors that you talk to and are listening to this podcast are aware of, that's a 1031 exchange.
Right.
You can do a 1031 exchange, roll your property into a new property, whether that's, Delaware statutory trust type property, whether that's a commercial property, something larger, something similar in the same time, in the same range as your original property, and you can defer all those taxes. So that's probably the number one way for investors to kind of get out of one property and then avoid the depreciation recapture. But what's also important to note is that that depreciation recapture amount doesn't go away, right? You don't roll it into a 1031 exchange and then that $50,000 of depreciation just gets rolled into the new basis and, oh, I don't have to worry about that ever again. No, whenever you sell that second property, you still will get hit with the depreciation recapture. So you just have to make sure you track that and you're always aware of it. The only way you're really going to fully avoid that is, the ultimate end game of a lot of real estate investors. You hold it all the way till the end, being, the end of your life.
When you shuffle off this mortal coil.
You shovel off this mortal coil. It's difficult to talk about. I always struggle with the way to phrase that in a meeting. But yeah, that's always the best way, right? Then you get a depreciation step up, and the whole asset gets stepped up to a new basis, whatever the market value is at the time of death, and then your children get this brand new asset that they can sell immediately, and then have no capital gains, no depreciation recapture. That's really the best end game for real estate investing. I'm sure that you know.
Yeah, no, it's a great model. And one thing that we sometimes talk about when we talk about passive real estate investing is the notion of a lazy 1031 exchange, where instead of doing a formal 1031 exchange, you invest in a syndication. A few years go by, the sponsor sells the syndication. Ordinarily, you would be paying capital gains tax and depreciation recapture on that. But if you keep reinvesting in new syndications, you'll get new depreciation right up front that can offset that depreciation recapture, offset the gains. And it's a really easy way to do it without following all the really strict rules and timelines required by a 1031 exchange. So it's something that we like as a model. It's nice and simple. You just have to invest in something new in the same calendar year. And one thing that I and so many novice investors, when they first start investing, struggle with is they think, oh, if I don't deduct for depreciation on my tax returns while I own a property, then I don't have to pay depreciation recapture when you sell it. My CPA disabused me of of that misconception in the first time I went to sell a property, and they're like, no, you still owe depreciation recapture. And I was like, but I didn't take it. And they're like, well, shame on you then.
Oh yeah, and just to be clear on the shame on you, like literally the IRS acts as if you did. So you
Right.
can't like go back in time and take that depreciation. You've lost it and you'll pay taxes on it.
Paying double taxes, basically.
Yes,
Yeah.
100%. So that is definitely the worst thing you can possibly do. So if there's any mom and pop real estate investors out there, take the depreciation. You're not doing yourself any favors by not taking it.
Right. You're still going to get taxed for depreciation recapture, regardless of whether you take the depreciation or not while you own the property. So,
100%.
all right. So, Sean, in 30 seconds or less, how do you help people and how can they connect with you if they want to take you up on that help?
Absolutely. Thank you. Thank you for having me, Brian. I am a flat rate financial planner. I help people achieve their financial goals through financial planning. I also do tax preparation, tax planning, and wealth management through my firm, Purpose Built Financial Services. You can find me online at purposebuiltfs.com, or you can just Google my name and you should come up on all the social medias, LinkedIn, Twitter, YouTube. So please, if you need any help, reach out to me.
Sean, well, thank you so much for coming. And I love the one-stop shop model that you have of, CPA tax services with the financial planning services. So love that. And guys, if you enjoy these quick hit conversations that we have focusing on, one quick topic at a time, please rate, review the show. Makes a world of difference to us. And we will catch you on the flip side. Wondering how private equity real estate investing works? We get it. A lot of investors are put off by phrases like private equity or real estate syndication, but these completely passive investments are actually a lot easier than buying properties directly, buying properties yourself in your own name. So we offer a free 40-minute class called Hack the Rich, 7 Secrets We've Learned from Private Equity Real Estate. There's not even a sales pitch at the end. We'll show you how to invest in these on your own without any help from us. So go to sparkrental.com/hack to take the free class. And we can't wait to chat about your questions.